Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. To earn alpha in the stock market, an investor must act differently from the crowd. You know how in a race everyone starts at the same line? Well, the stock market is kind of like that. If you want to finish ahead of everyone else, you can't just run the exact same way they do. You have to run your own race. A smart investor named Seth Klarman said it perfectly. The only way to do better than everyone else is to do something different. Now, one strategy which has a high probability of success is the 25-25 rule. This means always keeping a minimum of 25% of a portfolio in cash and 25% in stocks. The remaining 50% is moved between the two based on market valuations. When stocks are expensive, the cash pile grows. When a bear market hits, that cash is used to buy undervalued gems. Now, gold has been super popular lately, breaking price records. So, some people are asking, hey, instead of keeping that 25% in boring cash, can I keep it in exciting gold? On the surface, the case is strong. Gold has outperformed many indices over the last 5, 10, and 20 years. However, for a disciplined value investor, replacing cash with gold may not be the right thing to do. The most common mistake in investing is driving while looking only in the rear view mirror. You would crash. Just because gold did amazing for the last few years does not mean it will keep doing that forever. From roughly 2012 to 2019, gold in India hovered between the rupees 30,000 and rupees 35,000 per 10 grams mark. For 7 long years, the yellow metal was nearly flat. During this period, even a basic fixed deposit would have easily beaten gold's returns. Now, the critical point is that in 2019, no one had a crystal ball. There was no way to know a historic bull run in gold was coming. Therefore, basing a future strategy solely on the best performing asset of the recent past is often a recipe for disappointment. It is like betting on a horse after the race is already over. The next 7 years for gold could easily look like those stagnant years between 2012 and 2019. So, to understand why cash is superior for this strategy, one must look at the purpose of the non equity portion of a portfolio. In a value investing framework, the 25% cash component is not there for aggressive growth. Its job is not to boost returns. Its role is singular and simple: to preserve principal. You have to understand the job of that 25% cash pile. Its job is not to make you the most money. Its job is to be your safety anchor. Now think of your whole treasure chest like a ship. Stocks are the sails. They catch the wind and make your ship go forward fast. Cash is the anchor. It does not make you go fast, but it stops your ship from tipping over in a storm. So when the stock market gets crazy or a storm hits, your cash anchor keeps everything steady. Gold is not an anchor. Gold is like a second different sail. It gets pushed by things like global fear and inflation. So when stocks go on a big sale, you need your dry powder. That's a cool name for your ready cash to buy them. You need money that is guaranteed to be there. If your safety money was in gold and gold suddenly dropped 20%, your safety net would be gone right when you needed it most. The famous investor Warren Buffett said, cash is like oxygen. You only notice how important it is when it's gone. Value investing is built on the concept of intrinsic value. Investors buy businesses because they generate profits, grow earnings, and pay dividends. A company has underlying worth based on its future cash flows. Gold has none of these things. Charlie Munger was famously critical of gold for this reason. He believed that investing should be about productive capacity. Gold produces nothing. If you own an ounce of gold today, a century later, you still own exactly 1 ounce of gold. Its value is entirely subjective. It is only worth what someone else is willing to pay. For the value investor, taking risk in the equity portion of a portfolio is a calculated move. To balance that risk, the non equity portion should carry virtually no risk to the principal. Mixing a safe haven asset with the speculative nature of gold increases the overall risk profile of the entire portfolio. Now, this does not mean that gold has no place in a financial plan. It is a classic hedge against the debasement of currency and a store of value during systemic crisis. As part of a broad diversified asset allocation, gold can be a sensible component. Most experts suggest a 5% to 10% weightage. If an investor believes that global uncertainty is rising, he might even increase that allocation to perhaps 15% to act as a more robust insurance policy. However, gold should remain separate from the core equity strategy. Do not mix your safety anchor, which is cash, with your insurance policy, which is gold. Keeping your cash safe and ready lets you be brave and smart with your stock picks when great opportunities appear. By having a strong, boring cash anchor, you make sure you always have the dry powder to grab amazing deals. While the allure of gold's past performance is strong, long term success requires discipline. Sticking with the boring safety of cash allows an investor to be bold and ambitious with their stocks. By keeping the foundation stable, an investor ensures they have the dry powder, which is, of course, cash, necessary to strike when the market presents the next great opportunity. So, how do you balance your dry powder? Do you prefer the safety of cash or the hedge of gold? Well, you can leave a comment below and share your views. That's all from me today. I'll see you again in the next session. Goodbye and happy investing.